It does take us to our talk of the tape, how best to position in this fast-moving market. Let's ask Ann Sonders, Chief Investment Strategist for Charles Schwab. Welcome back. It's good to see you again.
Good to see you too, Scott.
So we have this nice move over the last couple of days. Do you believe in it? Do you think last week was the worst of it? How are you feeling about this market?
Well, broadly, the market had gotten a bit oversold, especially in areas that had really taken a drubbing. The technology sector had dropped intraday to only 10% of stocks trading above 50-day moving averages. And I think that enticed some buyers, not to mention earnings from some of the mega cap names this week, maybe elevating some interest on the buy side. I think it also didn't eliminate a lot of the froth, but maybe ease some of the froth that in and of itself had been a concern. So I think we probably revert back to the kind of leadership we were seeing before, but you're going to get these moves on a day-to-day basis where some of the laggards get a bid.
Wait, so you're suggesting that mega cap is going to once again take the lead and stay there? This idea of rotating or broadening is not believable?
No. I'm saying this year's winners until recently will probably go back into the leadership position, meaning energy and materials and financials to some degree. I think we get these relief rallies in areas that were last year's darlings, but I believe more in the persistence on the traditional cyclicals, barring more significant weakness that shows up in the economy.
Oh, so you're on the same train then as Jamie Dimon, who was speaking today at the Economic Club not that far from here, where he said the economic boom, quote, is unbelievable. Even if we go into a recession, the consumer's still in good shape. So you're playing for the strong and continuing to be strong economy.
Yeah, so I actually think that we may start to see a little bit of pressure on the consumption side of the economy, but I think the more traditional cyclical areas represented by, given what's going on in commodities, materials, again, financials, I think that there was a value trade that kicked in there, and energy, maybe for obvious reasons. So those are, Scott, I think, as you know, we relaunched Schwab Sector Views earlier this year after a two-year hiatus during which we were focused more on factors. Now we focus on both. But fortunately, the three outperform ratings since we relaunched have been on financials, energy, and materials, and that has not changed. And we think at least near term, that's likely to continue to be where you see performance leadership.
How much do you think this bull market since the October bottom was based on the idea of rate cuts? And how much do you think it was based on the fact that the economy is just strong, and that matters more than anything else at the end of the day?
I think it's more the latter than the former, but I also think the rally was driven by what happened with Treasury yields more so than the parlor game of expectations around, when will the Fed cut and by how much. The move from, 5% on the 10-year yield at the end of October down to 3.8% was just a powerful tailwind for the overall market, and that's why you saw a significant move by small caps during that downturn in yields. I think the recent turn back up in yields initially was to the detriment down the cap spectrum, the zombie type companies, and then more recently started to hit some of the larger cap companies. But I think the resilience in the market has to do with the resilience in the economy. That said, as you know, there's a lot of churn under the surface. The average NASDAQ member has had a 32% drawdown this year. So you don't really get a full picture of what's going on in the market if you only look at index level changes. The real story has been under the surface.
Sure, but if we get no cuts this year, or maybe even one, but it's pushed way off until towards the end of the year, you still comfortable with this market as long as the economy remains resilient?
If the economy remains resilient, we don't get a significant turn back up in inflation, I think the market is probably okay. A significant turn up in inflation or deterioration in the geopolitical environment and $100 oil that starts to have feeder effects into other inflation, and the Fed is stymied in a slowing economic environment by not being able to cut to combat the slowing economy because of inflation. That would not be a great scenario. So it would be the why behind what the Fed does. What amazes me is, again, this parlor game of when will they start, how many cuts. There's very little that I hear behind that analysis. Like, I think the Fed's going to start, fill in the blank, July, September. And the reason why is, here's what I anticipate in terms of the monthly readings on core PCE or core PCE services, X housing. Here's how the base effects work. So this gets you to something close to the Fed's target. And here's what I expect on the economy. And that gives the green light for the Feds to start cutting. It's more just like throwing a dart at the month start point. It depends on the data. And I think that gets lost in this parlor game.